Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of top portfolio rebalancing strategies to keep your investments on track. Balancing your investment portfolio can feel like a juggling act. One wrong move, and you might find your asset allocation completely off track. Portfolio rebalancing is crucial to keep your investments aligned with your financial goals and risk tolerance. In this video, we'll break down the best strategies for maintaining optimal asset allocation. You'll discover practical tips and actionable steps to help you rebalance your portfolio effectively. Whether you're new to investing or a seasoned pro, understanding these strategies will enhance your investment management and long-term returns. Let's make sure your portfolio stays on course. Understanding portfolio rebalancing. Keeping your investments in shape is not just about choosing the right assets. It's also about maintaining the right balance over time. Portfolio rebalancing is a key practice in ensuring your investments stay aligned with your goals. In this section, we'll explore what portfolio rebalancing is and why it's so important. What is portfolio rebalancing? Portfolio rebalancing is the process of adjusting the weights of the assets in your investment portfolio. Over time, the value of different assets will change, causing your portfolio to drift away from its original allocation. This means some assets might grow faster than others, altering the balance. Here's a simple example. 1. Suppose you start with a portfolio that is 60% stocks and 40% bonds. 2. Over time, if stocks perform well, they might grow to make up 70% of your portfolio, leaving bonds at 30%. 3. Rebalancing would involve selling some stocks and buying bonds to return to the original 60-40 split. By doing this, you ensure that your portfolio remains aligned with your risk tolerance and investment goals. Why is portfolio rebalancing important? Rebalancing your portfolio is critical for several reasons. 1. Maintaining risk levels. If certain assets grow disproportionately, your portfolio might become riskier than you intended. 1. Rebalancing helps maintain your desired level of risk. 2. Staying on track with goals. Your financial goals are likely based on a certain asset allocation. 2. If your portfolio drifts, you might not achieve the returns needed to meet those goals. 2. Regular rebalancing ensures you stay on the right path. 3. Taking advantage of market movements. Rebalancing often involves buying low and selling high, which can enhance returns. 3. By selling assets that have performed well and buying those that haven't, you can capitalize on market fluctuations. 4. Preventing emotional decisions. The stock market can be unpredictable, and it's easy to let emotions drive your decisions. 4. Rebalancing imposes discipline, helping you stick to your strategy rather than reacting emotionally to market changes. In essence, without regular rebalancing, your portfolio can become unbalanced, leading to increased risks and misaligned goals. By keeping a regular check and making necessary adjustments, you ensure that your investments remain steady and goal-oriented. Types of portfolio rebalancing strategies. There are several ways to keep your investment portfolio balanced. Each strategy has its own method and benefits, so it's important to find one that fits your needs. Let's explore the different types of portfolio rebalancing strategies. 1. Calendar rebalancing. Calendar rebalancing is a simple and effective way to manage your portfolio. In this strategy, you rebalance your investments at regular intervals, such as monthly, quarterly, or annually. Advantages. 1. Predictability. Knowing you'll rebalance on set dates makes planning easier. 2. Simplicity. This method is easy to understand and implement. Disadvantages. 2. Market changes. It may not respond quickly to sudden market shifts. 3. Fixed timing. You may rebalance when it's not the best time for the market. Calendar rebalancing is like setting a regular doctor's appointment. You check in regularly to ensure everything is on track, rather than waiting for symptoms to appear. 2. Threshold rebalancing. Threshold rebalancing involves adjusting your portfolio when the asset allocation deviates by a certain percentage from its target. For example, if your target is 60% stocks and 40% bonds, you might rebalance if stocks rise above 65% or fall below 55%. Pros. 1. Responsive. This method quickly addresses significant changes in the market. 2. Flexibility. You can set your own thresholds based on your risk tolerance. Cons. 1. Potential frequent adjustments. If the market is volatile, you might rebalance too often. 2. Complexity. It can be harder to track compared to a set schedule. Think of threshold rebalancing like a thermostat. It adjusts the temperature only when it moves outside your comfort zone, ensuring optimal conditions without constant tweaking. 3. Hybrid rebalancing. Hybrid rebalancing combines calendar and threshold strategies. You rebalance at regular intervals, but only if your allocation deviates beyond a set threshold. How it works. 1. Set a schedule. Choose a regular interval for review, like every quarter. 2. Set thresholds. Decide on acceptable percentage deviations for your assets. 3. Rebalance. Only adjust your investments if they have moved beyond the set thresholds during your scheduled review. Benefits. 1. Balanced approach. Combines the predictability of calendar rebalancing with the responsiveness of threshold rebalancing. 2. Reduced effort. Reduces the need for constant monitoring while still keeping your portfolio on track. Hybrid rebalancing is like a car's maintenance schedule. You perform regular checkups but only make adjustments when something is noticeably off. Choosing the right rebalancing strategy depends on your individual goals, risk tolerance, and investment style. Understanding these methods can help you maintain an optimal asset allocation and keep your investments aligned with your financial objectives. Steps to implement portfolio rebalancing. Rebalancing your portfolio is essential to keep your investments aligned with your financial goals and risk tolerance. Let's walk through the key steps to effectively rebalance your portfolio. 1. Assess current portfolio allocation. The first step in rebalancing your portfolio is to evaluate your current asset allocation. This involves looking at how your investments are distributed across different asset classes, such as stocks, bonds, and cash. 1. Review account statements. Start by reviewing your latest account statements. 1. This will help you see the current value of each investment. 2. Compare to target allocation. Check if your current allocation matches your desired target allocation. 2. For example, if your goal is 60% stocks and 40% bonds, see how close you are to that split. Understanding where your portfolio stands helps you determine the changes needed to achieve your ideal balance. 2. Determine target allocation. Next, decide on your target asset allocation. This should reflect your risk tolerance, financial goals, and investment timeline. 1. Risk tolerance. Assess how much risk you can handle. 1. If you're comfortable with potential losses, a higher percentage in stocks might be suitable. 1. If you prefer stability, lean more towards bonds and cash. 2. Investment goals. Consider what you're investing for. 2. Are you saving for retirement, a house, or your child's education? 2. Your goals will influence your target allocation. 3. Time horizon. Think about when you'll need the money. 3. Longer time horizons allow for more risk-taking, while shorter ones require safer investments. Setting a clear target allocation ensures you know exactly where you want your portfolio to be balanced. 3. Identify assets to buy or sell. After assessing your current allocation and setting your target, identify which assets need adjustments. This might involve buying or selling certain investments. 1. Overweighted assets. Look for asset classes that have grown too large. 1. For instance, if stocks have outperformed and now make up 70% of your portfolio, when your target is 60%, you might need to sell some stocks. 2. Underweighted assets. Check for asset classes that are underrepresented. 2. If bonds only make up 30% of your portfolio but your target is 40%, consider buying more bonds. By pinpointing the assets to buy or sell, you can take specific actions to steer your portfolio back to its target allocation. 4. Execute transactions. Once you've identified which assets to adjust, it's time to execute the necessary transactions. Follow these steps to rebalance your portfolio effectively. 1. Log into your investment account. Access your brokerage or investment platform. 2. Place sell orders. For assets that are overweighted, place sell orders to reduce their share in your portfolio. 3. Place buy orders. For assets that are underweighted, place buy orders to increase their share. 4. Review and confirm. Double-check all orders before finalizing. 4. Ensure that the transactions align with your target allocation. By carefully executing these transactions, you will bring your portfolio back to its desired balance, maintaining optimal asset allocation and helping you stay on track to meet your financial goals. Mastering portfolio rebalancing is key to staying on track with your financial goals. Regular adjustments help maintain your desired risk level, align investments with objectives, and capitalize on market movements. Different methods, like calendar, threshold, or hybrid rebalancing, offer unique benefits and can cater to your specific needs. Use tools like robo-advisors or portfolio management software to simplify the process, or consult with a financial advisor for personalized advice. Remember, the goal is a balanced portfolio that supports your long-term financial success. Keep rebalancing in your strategy to keep your investments steady and aligned. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.